What's up, everybody? Zillow has once again had a shift in their home price forecast, but this time it's a lot more bearish. Since February, Zillow has raised their home price forecast every month all the way through August. As we spoke about in recent videos, they had forecasted home prices going up 6.5% over the next 12 months. Just for reference, the average annual increase in home prices is around 5.5% as tracked by Case-Shiller. So now, this past week, the Zillow economists have revised their home price forecast downwards and predict U.S. home prices will still rise, but by only 4.9% between August 2023 and August 2024. Zillow's forecast of the nation's typical home value was revised downward this month due to the anticipation of higher mortgage rates and a slight decrease in market tightness, wrote the economists at Zillow. Zillow also revised their home sales forecast to 4.1 million this year, down from 4.2 million in their previous forecast. It seems that Zillow has now hopped on the train that believes that mortgage rates will stay higher for longer than they did previously to try to combat inflation. And after the Fed hinted at raising rates one more time this year, I don't blame them. According to Bankrate, the 30-year fixed mortgage rate climbed 24 basis points last week to 7.75%. In addition, new listing inventory increased slightly, which was one of the reasons Zillow decided to downgrade their home price forecast. August brought an unexpected late summer uptick in the number of new for-sale listings entering the market. New listings increased by 4% from July to August, the first time in Zillow's records in which the inflow of listings increased over that 2-month span. To be clear, August new listings total, as well as total for sale inventory, remains well below the typical levels seen prior to the pandemic, and inventory conditions remain very tight. That said, this unusual late summer supply uptick helped to ease market conditions some, causing our outlook for home values to cool, wrote the Zillow economists. This isn't the first time that inventory has affected home price forecasts. In fact, it's the inventory shortage that's keeping home prices so high due to the supply-demand issue. The National Association of Realtors reported 1.1 million homes on the market in August, a 14% drop from a year ago, and the worst inventory figure for the month of August since 1999. Home builders, meanwhile, are building homes at a slower rate as their home loans are also more expensive. The number of new homes under construction fell to 1.28 million last month, according to Commerce Department data out on Tuesday. That's the slowest pace of new construction since June of 2020, according to Reuters. But even with low inventory, not everybody is projecting a home price increase over the next 12 months. Both Morgan Stanley and Moody's Analytics think that home prices will go down by the end of 2024. Moody's says it's premature to celebrate the end of the housing correction and expects median home prices to decrease by 3.5% between the fourth quarters of 2023 and 2024. And Morgan Stanley forecasts home prices to fall 2% by the end of 2024. You also have some experts that think we will experience a black swan event like we did back in 2008. A black swan event is something unpredictable and rare and is seen as paradigm shifting. According to Sean Terry, founder of the real estate investment company Flip to Freedom, we will experience a black swan event in the next 6 to 8 months. How do you make housing affordable? If you have to raise interest rates, the prices have to come down. Something will crack, and I think we're gonna have a black swan event probably in the next 6 to 8 months that's gonna rock the markets. He points to the Fed Reserve and its efforts to fight inflation as what could push the housing market toward a black swan or unpredictable event with severe consequences that is beyond what is normally expected, but in hindsight seems obvious. I think they're on this path to continue to raise rates because they want to crash the market. They want affordability to come out, Terry said of the Fed. Now, I don't necessarily agree with Terry that the Fed wants to crash the housing market, as that would cause other problems, but instead is trying to create more affordability without causing a deep recession. Whether or not they'll succeed is still up for debate. Right now, we have a divided housing market where some places are seeing multiple offers and price increases, while other places are seeing prices decline. Terry believes the Fed's going to continue to hike up rates. Plus, he noted there is an election year coming up that could influence this black swan event that's going to rock the markets. He also compared the housing bubble that preceded the Great Recession of 2008 and the dozens of banks that failed amid the subprime mortgage crisis to the 3 banks that failed in 2023: Silicon Valley Bank, Signature Bank, and First Republic. When comparing those banks' total assets, adjusting for inflation, they were larger than the 25 banks that failed in 2008, the New York Times reported. That being said, most housing experts believe that a 2008-like housing crash is not imminent due to the housing shortage, even with these high interest rates. Whether you're in Terry's camp of an impending crash or in the other housing experts of avoiding a crash, one thing we can all agree on is that we do have an affordability crisis on our hands. Something has to give. Lawrence Yun, the National Association of Realtors chief economist, told Newsweek that the housing market's problem is limited supply, which predated the pandemic, when there was a shortage of about 4 million to 5 million housing units in 2019. That came about due to population and job growth that outpaced new home construction, Yoon told Newsweek. Then, the shortage worsened during the first year of the COVID-19 real estate boom, as many desired to take advantage of the historically low interest rates. The shortage intensified when mortgage rates shot up due to homeowners who have been unwilling to list and give away their locked-in low rates. Yoon sees 2 possible scenarios playing out due to a variety of factors, Newsweek reported. One scenario has home builders upping their construction, mortgage rates going down, and more buyers entering the market. Home prices are not crashing in this scenario, Yoon told Newsweek. Home price growth will depend on whether home builders can bring sufficient supply to the market. The other scenario, Yoon said, is if an economic recession leads to job losses and, in turn, forced selling of homes and less consumer confidence. That would also lead to much lower interest rates and would encourage those employed Americans to enter the market. This scenario may cause home prices to rise faster, especially if some wealthy people decide to reallocate investments from the stock market to real estate, Yoon said. We will not have a repeat of the 2008 to 2012 housing market crash. There are no risky subprime mortgages that could implode, nor the combination of a massive oversupply and overproduction of homes. So I ask you guys, where do you stand? Which camp are you in? Comment below and tell us your opinion. I mean, we're all in this together, and I really do value your opinion. And tell us where you live so we can see your perspective. And if you are getting some value out of these videos, and it's not too much trouble, give me a thumbs up, press that like button, consider subscribing to our channel. It just helps us with the YouTube algorithm. Frankly, it motivates us to make more videos. I usually end these videos with the data from Redfin's latest housing market update, but honestly, it really hasn't changed much from last week. So if you want to see it, definitely check out that video next. I hope you can tolerate my less than healthy voice. Thanks for watching. I do appreciate it. Bye!